Welcome to the Financial Decisions for Young Adults webinar. My name is Rachel McKinley. I am the Vice President of Marketing at Maine Family Federal Credit Union, and I am also a certified credit union financial counselor. Today's agenda, we are going to spend our time today on navigating some of the big financial decisions that young adults must make. So what comes after high school? If it's college, how are you going to pay for it? And how does that decision impact your money after college? There's one question that most high school seniors are tired of being asked. It is, what are you doing after high school? Making a big decision about what's next, which is a decision that can shape the next several decades of your life, is a lot of pressure. We're not here to ask you that question today. Instead, we're here to help you better understand some of the different options you may be considering as you make that big decision. Whether you have decided on a path or not, we want to start our time today by talking about some of the different decisions that you might make after high school and then the key things to know for each. The first path you may decide to take is entering the workforce by going straight to a full-time job. Full-time is typically defined as 40 hours a week, though in some cases that exact number of hours can vary. So for example, if you work 3 12-hour shifts, that's 36 hours a week, but it's still considered a full-time position. Starting a full-time job can be really exciting, especially because your paychecks will likely be bigger than what you earned working part-time while in high school. That total amount of money you earn before anything is taken out is your gross pay. There are two common ways that you might be paid. You may be paid a salary, which means you earn a set amount of money each week, no matter how many hours you work, as long as you're meeting your job expectations. Or you may be paid hourly, which is probably what you're familiar with a part-time job. And it means that you earn money based on the number of hours that you work. So your paycheck can change from week to week depending on how many hours you actually put in that week. But here's the important part. The amount you actually take home is usually less than your gross pay. That's because things like taxes and other deductions are taken out first. The amount you keep after those deductions is called your net pay, and that's what you'll see actually deposited into your bank account. Deductions include state and federal income taxes, Social Security and Medicare taxes, as well as the cost of any optional benefits your employer may offer. Those optional benefits will vary by employer, but will typically be explained as part of the benefits package when you're offered a job. Some common benefits include health, dental, and vision insurance, along with things like retirement plans and extra savings account for certain expenses. Some of those specific savings accounts can be flexible spending accounts or health savings accounts, and those are both ways for you to set aside money from your paycheck before taxes to pay for things like medical bills or childcare. These can help you save money overall. However, there are some rules about how and when you can use these accounts, and HSAs are typically only available if you have a certain type of health insurance plan. So it's important to understand how they work before you sign up. Some of the benefits are fully paid by your employer, some are shared costs, which mean you pay a portion and your employer pays a portion, and some you have to pay for yourself. If you have a spouse or children, you can often add them to your benefits for an extra cost. It's very important to know that any benefits you pay for are taken out of your paycheck before you receive your take-home or net pay. So if you decide not to go directly into the workforce, one of your options is to go to trade school. Trade school offers programs designed to train people in a very specific skilled trade. For example, maybe commercial driver's license programs to learn how to get your CDL and learn how to drive big trucks. These programs are typically very focused on learning the skills themselves and are often shorter than a 2 or 4-year college degree program. In some cases, you can start working toward a trade school degree through dual credit programs while in high school. Since trade schools are different from a more standard college or university, there are some key questions you'll want to ask your trade school if you're considering attending. First, what financial options are available? While trade school programs often cost less than traditional college degree programs, federal financial student aid options may not be available for all trade school programs. Trade schools may offer their own financial aid options, so exploring what those options are is important to do early on. Next, it's important to ask if the school is accredited. This can change what kind of financial aid options are available and can be important in ensuring that you're getting a quality education that will be honored while you're trying to get a job. It's also important to look at what happens after you finish your trade program. How many graduates actually get jobs in that field? Does the school help you with things like resumes or job placement? Finding out the income earning potential for that specific trade career you're considering can also help you weigh whether the cost of the program is worth it. This is important to know as you consider whether this career fits in with your long-term financial goals. While we mentioned trade school programs are often shorter than standard degree programs, you'll want to ask exactly how long that program is. And finally, ask about the school's reputation with local employers that are hiring the people with the skills that you hope to obtain. Don't just call the school and ask them this, call employers and ask them. Attending a trade school with a strong reputation can make a huge difference when you're landing a job. While some young adults are ready to leave their hometown and have a clear career path in mind, others are still figuring things out, and that's absolutely okay. It's really hard to figure out at 18 years old what you want to do with the rest of your life. And if that's the case, community college can be a great option if you're not 100% confident of your field of study. Even if you do know your field of study, taking classes at a community college that can be transferred to a four-year school can save you a significant amount of money. Be sure you understand what courses can be transferred to your four-year school and major of choice, though, and know that different schools may have different transfer policies. Community colleges often offer a variety of options for scheduling classes, which makes it easier for you to work while you're attending school. Some community college programs can be done entirely in the evenings, on weekends, or online. This flexibility can be super helpful for somebody who needs to earn an income while attending school. While community colleges may have a less active campus life than a four-year college or university, this may not be a bad thing. Having less distractions or feeling like you're missing out on things can be helpful if you're focused on your studies or also working while you attend school. But at the same time, it's also important to balance your work hours to make sure that you can fulfill your school duties. And the final option you may be considering is going straight to a four-year college or university. This option is typically most expensive of the options we've discussed, and there are a variety of factors that can impact just how expensive it is. As we talk about these factors, it helps to think about what your priorities are when it comes to choosing a school. Is keeping your cost to a certain amount a priority for you? Is it the school's location? Is it the reputation for the degree program you plan to pursue? Is it knowing that your friends will be attending that same school? Is it the campus life? These are just a few examples of priorities. Knowing what you are set on and what you are willing to be flexible on can help you make the best decision on what school you want to attend. If you do choose to go to a four-year school, consider the cost of the following choices you'll make. So location is your first. Many public colleges and universities offer discounted rates to residents of that state as tax dollars that go to support the school. In-state tuition can be a significant savings versus attending a school in a different state. Additionally, your cost of living will vary and can impact your overall college expenses if you go out of state. It can be tempting to want to spread your wings and head to a college very far from home, but it's also important to truly weigh all of the costs. Not only will your tuition be likely higher, but you'll also have to consider added travel expenses to return home for breaks, and even maybe the cost of transporting or storing your belongings at the end of the academic year. Sometimes it's unavoidable if you're looking for a specific program that isn't available in your area. But if you have a choice, location is one of the biggest things that directly impacts the cost of your college experience. Choosing between a public and a private school is another decision that has a big impact on cost. Public schools typically receive federal, state, and local funding that can offset some costs and keep that tuition lower up front. But private schools typically don't, as they are mostly funded by donors and tuition dollars.
According to U.S. News, the average cost of tuition and fees in 2025-2026 for that 2025-2026 academic year for a private college was $44,961, which is significantly higher than the average tuition fees at public universities and colleges, which was $11,371 for in-state students and $25,415 for out-of-state students. So that amount is for the tuition and fees per year and doesn't necessarily include room and board. Still, big savings for in-state schools. Choosing whether to live off or on campus can also play a direct role in how much a college costs. A key distinction here is whether you're paying for the housing as a lump sum upfront for on-campus housing or paying monthly for off-campus rent. Even if on-campus housing is slightly cheaper up front, you'll still want to weigh the added interest you'll pay if you're using student loans to cover the cost of room and board on campus. It's also important to know your school's rules. Some schools require underclassmen to live on campus for a certain number of years. And finally, your choice of major can have an impact on how much college costs based on the time it will take you to complete the program. So if you are looking to go to veterinary school, you can be assured that your college is going to cost you a lot more because you have to also go to veterinary school afterwards versus just getting a 4-year degree. Also, if you change majors, that can add to your cost as you lengthen the amount of time it takes for you to obtain the required credits to complete your program. Once you've explored your options, whether that's going straight into the workforce, attending trade school, or going to college, and then made your decision, the next step is figuring out how to pay for it if you choose an education path. If you're planning to continue your education, it's important to understand the different ways that you can cover those costs. We're going to walk through those options so you can make informed choices and avoid surprises later. If you haven't already, you'll want to talk with your family about how you're going to pay for college. Do you have a college savings fund? If so, find out how much you have and if it's a type of college fund that has specific rules for using this money. A common type of college savings fund is what's called a 529 plan. Some of those plans, they require you to go to school and state. Some plans may not allow you to use the money to pay for off-campus housing, and a variety of other stipulations on how that money is used. So it's important to know all of those before you choose a school. While you're researching ways to finance your college education, it's really important to look for scholarships and grants. These are forms of financial aid that you do not have to pay back, which makes them one of the best ways to pay for college. Scholarships can come from lots of places like schools, local businesses, community organizations, or national programs. Some are based on grades or activities, while others are based on things like your background, interests, or career goals. Maine Family Federal Credit Union offers a scholarship program each year and awards 3 $2,500 scholarships. The application period for our scholarship program opens in early January and is usually due by the end of March. And those are not based on grades, it's based on the well-roundedness of the student and their essays. So grants are another option and are usually based on financial need and are often awarded through your FAFSA. Again, grants do not need to be paid back. When you're searching for scholarships, it's important to start early and apply for as many as you realistically can. Smaller local scholarships can sometimes be easier to win because fewer people apply. Throughout the process, it's crucial to be organized. Keep track of your deadlines, the requirements, and your essays so you don't miss opportunities. Some employers offer tuition reimbursement as part of their benefits. That means they'll help pay for your college classes while you're working for them. In many cases, those classes need to be related to your job, and there's usually a limit on how much they'll pay each year. Tuition reimbursement can be a great option if you're still looking to earn money and gain work experience while you're working toward a degree. It may take a little longer for you to finish school, but it can definitely reduce how much you're paying out of pocket. Compared to student loans, this can make a big difference. With tuition reimbursement, your employer helps cover those costs, you don't have to pay it back. With student loans, you're borrowing money and have to repay it later, often with interest. So while tuition reimbursement may take more time and planning, it can help you avoid taking on debt. Perhaps you're in a position where you plan to work through school and pay for your tuition and expenses as you go. Paying out of pocket, while rare, is also a great way to enter the workforce without the weight of student loans to be repaid. And finally, perhaps the most common way to pay for school is student loans. If you're among the large number of students who opt to take out student loans, the various choices can be overwhelming. So we're going to spend some time reviewing the features of the different loan programs to help you make informed decisions. To get any type of federal or student loan, you'll have to fill out the free application for federal student aid, which is the FAFSA. It must be filled out every year to determine your aid award for the next school year. The FAFSA opens applications on October 1st every year, and it is highly recommended you set a reminder on your calendar and fill it out as early as possible starting your senior year of high school. And you'll need to continue filling it out every year until you graduate from college. Some financial aid runs out, and later applicants who are otherwise eligible may be denied funds due to lack of availability. So earlier is better to make sure that you get in on those pools of money available to you. The aid you're awarded is good for one academic year, which runs from July 1st through June 30th. After you submit the FAFSA, you'll get a report that shows the information you entered and confirms everything is complete. It also includes an estimate of how much your family is expected to pay for college. Schools use this information along with the cost of school to figure out your financial need. This helps determine what types of financial aid you may qualify for, like grants, scholarships, or loans. Once you apply to a college, that school will put together a financial aid offer for you. Each school may offer something different based on their costs and the funding they have available. For example, you might receive more financial aid from a more expensive private college than you would from a lower cost public school. So it's important really to consider the total cost and ensuring that you have the degree program that you need and the support you need. And as your family's financial situation may fluctuate from year to year, the amount of aid you are eligible for may change from year to year as well, which is why you have to fill out that FAFSA every year that you're in school. So if you are ready to fill that out, visit fafsa.gov to fill out the form annually. Again, on or soon after October 1st, starting your senior year at high school, and then all the way up through graduating. Now that we've talked about how financial aid is determined and the different types of aid you might receive, let's take a closer look at one of the common options, which are student loans. So subsidized federal loans are subsidized by the government, and you do not pay interest while you're in school. The government pays that interest for you and then for a little bit of time after you leave. Unsubsidized student loans are for students who do not meet financial needs test or do not receive enough subsidized loans to fully cover their expenses. The interest will accrue while you're in school. So when you're in repayment, the interest rates on unsubsidized loans are the same as subsidized loans, but you'll have to remember that you are paying more in interest because it has compounded over those 2 to 4 years that you are in college. While subsidized or unsubsidized student loans would be taken out in the name of the student, Parent Plus loans are taken out by the student's parents. On paper, these loans are fully the responsibility of the parent. The student is not financially responsible for these loans in the eyes of the lender. While some parents may make agreements with their students to pay the loans back personally, the loan itself would be issued in the parent's name and be the parent's responsibility to repay. Parent Plus loans are federal loans that parents can take out to help pay for college. In the past, parents could borrow up to the full cost of attendance minus any other financial aid. Starting July 1st of 2026, there are new limits. Most parents can now borrow up to $20,000 per year and $65,000 total per student over the course of your education. These loans are available to parents at all income levels, but they do require a credit check. If a parent is denied due to credit, they still have options. They can apply with an endorser, which is similar to a cosigner, or they can appeal the decision. It's also important to know that newer Parent Plus loans have fewer repayment options and are typically paid back on a standard schedule, which can mean higher monthly payments. Both the interest rate and origination fees are typically substantially higher on Parent Plus loans than subsidized or unsubsidized loans. And finally, there is private student loans. These are originated by a private lender and are typically turned to by individuals who are ineligible for or have exhausted all of the federal student aid options without fully covering their education expenses. And that's the key here, is to make sure that you are exhausting all of your federal student aid options before you are looking for Parent Plus or private loans. If you do need private loans, Maine Family FCU partners with Sparrow, which is a marketplace that helps borrowers compare private student loan rates in one place. The application is on our website and takes just a few minutes and can provide rates from a variety of lenders depending on the borrower's creditworthiness. It's an easy way to compare rates and limit the number of credit inquiries you have when you're applying, so you're not applying to multiple lenders at once. And if you want more information, you can visit Maine Family FCU/Sparrow. Private student loans do not typically include the same benefits and protections that are guaranteed with federal loans. The interest rates, fees, repayment terms, and benefits are determined by the issuer and the borrower's credit standing and may vary greatly. Your student aid package may also provide you with an eligibility to join a work-study program. This program provides part-time jobs for students, many of which are on campus or provide a community service. Your school must pay you directly, so they actually issue a paycheck at least once a month, unless you request they send your payments to your student account for school charges like tuition, housing, or food. So it's important to remember that work study is part of your financial aid, but if you are using that to pay for other expenses, it will increase the amount of money that you may owe in the long run for your education, if you're not turning around and putting it right back on and not using that to pay on your tuition and room and board. If you're awarded the opportunity to participate in a work-study program, the amount you can earn is limited. Your federal work-study award will dictate to your school how much you're able to earn, and you cannot earn above that amount through the program. Your work-study amount will depend on when you fill out your FAFSA, your level of financial need, and how much funding your school has available. So once you've decided your path that you plan to pursue and you've figured out how you're going to pay for it, let's fast forward a bit to money after college, to how your money is going to work after college or trade school. So after you graduate can be a very exciting time. You know, you're an adult now. You're looking for a full-time job and hopefully moving out on your own. Those are things that you're going to dream about as a high school student. However, this can also be a very tricky financial time. You're earning a full-time wage if you find yourself a job and you're hopefully in your career field, but you may have student loans and other new expenses that you have to start paying for as well. As we discussed before when we talked about entering the workforce straight out of high school, it's important to know the difference between gross and net pay as you think about what your income will look like when you're accepting a job offer. Being a bit cautious with taking on expenses until you have started receiving a paycheck is recommended, so you can get a feel for how much money you actually have available to work with. So you've graduated college, you've landed a full-time job, and now it's time to look for a place of your own. You'll want to make sure you have a clear idea of what all the expenses that you have that you will be paying for out of your new income to determine what you can afford to spend on rent. Make sure you're considering all of your expenses, which is your rent, the utilities, so electricity, heat, internet, those kinds of things are all you need to make sure you take that into consideration. Do you need to buy furniture for your new apartment? Do you have transportation expenses? Do you have a car payment? Are you taking public transportation? How much is gas going to cost? How much is insurance going to cost? How much are tolls going to cost if you have to take the highway? You need to factor all of those things in. Groceries, that's a very big chunk of money every week that you are probably going to have to pay to make sure that you're being fed well. Clothing, do you need specific clothing for your job? Do you like to buy new clothes on a regular basis? Make sure that you include that factor in your budget. Entertainment, do you like going to the movies? Do you like going to concerts? What do you like to do with your friends? You like going out to eat? Those are all things that you want to make sure are included in your budget as well. Student loan payments, if you have student loan payments, those are probably going to be a significant chunk of your budget, and you want to make sure that you factor those in before you start looking at clothing and entertainment and all those things. And then any other debt payments that you may have, such as a credit card, or something along those lines. So if these expenses start adding up quicker than your new income can support, consider getting a roommate or two to help offset some of those expenses. You may also want to see if your parents might let you live at home for a little while after graduating so you can save up some money. Teens and parents both may roll their eyes at this idea, but remember, living with your parents will not be forever, and it can really help you start your post-college life off on the right foot financially. Especially right now with rent being as high as it is, it's really difficult for somebody to live on their own without a roommate. As you think about your new budget, we also recommend you think about your goals and how they may have changed. Are you in a career field that you want to be in the long term? Or do you have a growth plan in mind? Do you have a goal to relocate at some point? Do you want to buy a home? Do you think that you may want to go back to school for additional degrees or certifications? This is a great time to think about your bigger financial goals, short-term and long-term, and take steps toward those goals in your new budget. Student loans may be one of the biggest expenses you'll have after school, so it's important to think about how you'll manage them. When you leave school, most federal loans give you a 6-month grace period before the payments start. This gives you time to find a job and get settled. Private loans may be different, so always check with your lender. During that 6-month grace period, your loan servicer will contact you with your next steps. Make sure you read those messages and set up your payment plan on time. You'll have some options for how to repay your loans, but those options are changing starting July 1st, 2026. Many new loans will have fewer flexible income-based repayment plans, and most borrowers will be placed on a standard payment plan with a fixed monthly payment. So that's why it's important to borrow carefully and choose repayment options that fit your budget and your long-term goals. So let's take a look at some of the repayment options that you may have. The standard repayment plan will be in effect unless you request otherwise. So this will take your amount that you owe and break it up into regular payments. And then if you want a little bit more information, you can visit studentaid.gov/manage loans/repayment/plans. So as I noted, that standard repayment plan is a fixed monthly payment. Usually you pay it off in about 10 years and you pay less interest overall. It's definitely the most common option, especially with new loans. The simple takeaway for the standard repayment plan is that the plan you choose affects how much you pay each month and how much you pay overall. With fewer flexible options in the future, it's even more important to borrow carefully and plan ahead. There is also a tiered standard repayment plan, which offers fixed loan repayment terms in tiers of 10, 15, 20, or 25 years, and is based on the amount of money that you have borrowed. So say you borrow $100,000 for school, you will probably be put into a 25-year plan to help you lower your monthly payments. This plan automatically provides borrowers who have higher student loan balances with more affordable monthly payments by allowing the borrower more time to repay their loans. But it also means that you're probably going to pay more in interest because you're breaking it up over a longer period of time. There is a repayment assistance plan, which will provide borrowers with a simple and affordable option to repay their federal student loans based on their income. So this is replacing the income based repayment plan. Monthly payments are between 1 and 10% of your income, depending on how much you earn. In addition, your payments will be reduced by $50 per month for each of your dependents if you have dependents. These payments, as I mentioned, are based on your income, so they may be lower if you're just starting out. If you're making less money, your payment will be lower. This helps make your payments more manageable if money is tight and can reduce the risk of missing payments or going into default, which happens when you don't make payments for 9 or more months. The repayment assistance plan includes a feature that helps you pay down your loan faster. If your monthly payment doesn't reduce your loan balance by at least $50, the government will add up to $50 to help cover the difference. So you're actually paying off the principal and not just the interest. So along with this interest benefit, this makes sure that your loan balance is actually going down each month, not just staying the same or growing, because all you're making is payments toward the interest and you're not actually breaking down the principal. It's important to consider both your monthly budget and your long-term financial goals when choosing a repayment plan, because the plan you choose can directly impact how much you repay. If you can afford a higher monthly payment in your budget, this will typically reduce the amount of interest you pay back, as your repayment period will typically be shorter. If you can't afford much of a monthly payment, you'll likely pay more in interest over the time it takes you to repay your student loans. If you're in a situation where you have some flexibility with what you can afford on a monthly basis, use the student loan simulator at studentaid.gov to compare repayment plans and see a clear picture of how much total you could expect to repay under each plan. There's no wrong answer here. You want to make sure you're setting yourself up for success and agreeing to a monthly student loan payment that you can afford. If you're locked into something that you cannot sustainably afford, it's not going to be a good solution. Just be aware, however, that the repayment plan you choose may lead to more paid over time, that you want to keep that in mind, so you don't want to be paying more interest than you have to. If you're in a repayment plan and you find that you actually have a little bit extra, you can always pay more than your required monthly payment, and then most of the time you can change repayment plans as your needs and goals change. If you have some flexibility in where you choose to work, choosing to work for a public service loan forgiveness program eligible employer can be a great option. You can confirm employer eligibility using the Federal Student Aid Employer Search, which will be linked in the video below. Under this program, individuals who make 120 student loan payments under a qualifying repayment plan while also working for an eligible employer, which are typically government employers or nonprofit organizations, can apply to have their remaining balance forgiven. There are some very specific intricacies to this program, so contacting your student loan servicer as soon as possible after graduating, if you plan to pursue the PSLF, is a great idea, as they can help you ensure that you have the correct type of loans and are on the proper repayment plan. And finally, I want to encourage you, please do not ignore your student loans. Since most student loans are a federal debt, they can be unique and aggressive with their collection options if your student loans are not repaid. When a student loan goes into default status, meaning your payments were not made for 9 months or longer, this can impact your ability to get certain mortgages, to be eligible for new federal student loans if you want to go back to school, and a variety of other factors, in addition to weighing heavily on your credit score. The government has the ability to garnish wages, your tax refunds, and other benefits to collect on that debt. So I want to be clear, student loans typically do not go away, even in bankruptcy. If you have a student loan coming due and you know you can't afford the payment, communicate with your servicer before you fall past due. You may be eligible for an income-based repayment plan or a forbearance period if you're facing temporary financial hardship. I cannot stress this enough. Communicate as soon as possible with your student loan servicer to explore your options. Don't just let your student loans fall behind. So here at Maina Family, we want to set you up for a financially successful future, and we know the sooner you start, the better. We also partner with a nonprofit organization called Green Path Financial Wellness, who has a mission of empowering people to lead financially healthy lives. If you want to learn more about student loans, budgeting, or you have any other financial questions, Green Path offers free coaching and free and confidential coaching to help you live a financially healthy life. You can give them a call at 877-337-3399, or you can visit mainfamilyfcu/greenpath to learn more. And that is all I have today. Thank you so much for watching the Financial Decisions for Young Adults webinar. We hope that this was really helpful, and we hope that you will join us for future webinars. Thanks so much and have a great day.